All right, let's jump right in. Today, we're tackling a really interesting question for all you dividend investors out there. Is it time to think about a tactical shift, maybe rotating out of a beloved classic and into a newer contender? We're putting SCHD head-to-head with a fund called QDVO. Let's get into it.
You know, this quote from Tony Hicks really just nails it. For years, the ETF SCHD has been that go-to comfort food for so many portfolios. It's like the mac and cheese of the investing world. You know exactly what you're getting, and it's always satisfying.
But what happens when that comfort food starts to feel a little, boring? What if you're looking around at other parts of the market and starting to wonder, is there a different way to do this? A different way to generate income?
Now, let's be super clear about something. This is not some you gotta sell all your SCHD right now kind of explainer. Not at all. SCHD is a fantastic core holding. What we're doing here is analyzing a strategic rotation, thinking about when and why it might make sense to pivot into a fund that's running on a completely different engine.
So, to really get why you might make a switch, we first have to appreciate what we're starting with. So, let's do a quick dive into the reigning dividend king itself, SCHD.
So what's the secret sauce here? Well, it's pretty simple, and that's the beauty of it. It's a passive fund, it tracks a solid index of about 100 US companies with great fundamentals, and that expense ratio, a tiny 0.06%. It is the definition of a set-it-and-forget-it holding, and it's been that way for well over a decade.
Okay, so if it's so great, why is anyone even talking about alternatives? Well, the first reason is something called a style headwind. See, SCHD leans heavily into large value stocks. And in a market that's been dominated by mega-cap growth stocks, well, it's just lagged a bit. It's not a flaw, it's just a market cycle. But it can kind of feel like you're just treading water while other boats are speeding by.
And the second little wrinkle, it's all about when you get paid. SCHD pays out its dividends quarterly. Now, for a lot of people, that's perfectly fine. But if you're an investor who relies on that income to pay monthly bills, getting a check only 4 times a year can be a real pain for budgeting.
So if those are the potential issues with the classic, what's the alternative we're looking at? Well, let's meet the new contender, QDVO.
Right off the bat, you can see this is a totally different beast. This is no passive index fund. Nope, it's actively managed. It holds a much smaller, more concentrated basket of stocks, maybe 20 to 40, and it uses a really interesting tool to pump out that high monthly income, a covered call engine.
So what in the world is a covered call? Okay, think of it like this. You own a stock. You then sell someone else the right to buy that stock from you later at a higher price. Just for selling them that option, they pay you a fee, a premium, right here, right now. You are literally trading some of the potential future gains for guaranteed cash in your pocket today.
Okay, so we've met our two contenders. Now for the main event. Why on earth would an investor actually go through with this switch? Well, it really boils down to 3 main reasons.
The first reason is the most obvious one, the payout schedule. QDVO pays you every single month. For anyone trying to line up their investment income with their mortgage, their car payment, their grocery bills, this is a huge, huge practical advantage. It turns your portfolio into something that feels more like a monthly paycheck.
Reason number 2 directly addresses that style headwind problem we talked about. Instead of being stuck in the large value lane like SCHD, QGVO builds its portfolio around large cap growth stocks. So the idea to get you income while still having a stake in the part of the market that's been leading the pack.
And the third reason? Active management. You know, SCHD is on autopilot, which is great for keeping costs down. But with QVDO, you've got actual managers in the driver's seat, making calls on which stocks to own, and this is key, when and how to write those call options to generate income. You're basically betting that their expertise can add real value.
But, as we all know, there is no free lunch in the world of investing, so it is absolutely crucial to understand what you're giving up to get those benefits. We have to talk about the trade-offs.
And the first trade-off is a big one. It's the cost. Just look at this. SCHD is a dirt cheap 0.06%. QDVO, on the other hand, comes in at 0.55%. You're paying almost 10 times more for that active management and the option strategy. That's a performance hurdle the fund has to clear for you every single year.
This table is fantastic because it lays out the core differences so clearly. Let's walk through it. We've got passive versus active. We've got the style bias, large value versus large growth,
Look at the diversification, about 100 stocks in SCHD versus a much more focused 20 to 40 in QVDUL. Then there's the payout, quarterly versus monthly, but this last line, this is the most important trade-off of all. With SCHD, you get all of the potential upside from your stocks. With QVDUL, because you're selling those calls, your upside is capped. That is the fundamental deal you are making for that higher income today.
Now let's talk about where that high payout from QDVO is actually coming from. This chart is so revealing. You see that giant blue slice? That's return of capital, or ROC. And this is really important to understand. This is not a dividend in the traditional sense. The IRS basically treats this as the fund giving you a piece of your own investment back. Now, this can be super tax efficient, but you have to know it's not the same as a company paying you a dividend out of its profits.
And the final trade-off to consider is simply history. SCHD has been around since 2011. It has a long, proven track record through all kinds of markets. QDVO? It's the new kid on the block. It just launched in 2024. So you're trading more than a decade of real-world data for a much newer and, frankly, less tested strategy.
Okay, so we've laid it all out. The good, the bad, the trade-offs. Let's bring it all home. How do you decide if making a rotation like this is actually the right move for you and your portfolio?
This right here is basically your personal checklist. If you find yourself sitting there and nodding your head to most of these points, if you really need that monthly income, if you're worried about value stocks, if you're okay with capping your upside, and if you truly get what return of capital is, well then this switch might just be perfectly aligned with what you're trying to do.
And hey, if you do decide to make a move, don't just jump in with both feet. Do it intelligently. First, be really clear on your main goal. Then, decide if you're doing a full rotation or maybe just a partial one. You can own both. And maybe ease into the new position over time. Have a plan for that new income stream before it even starts hitting your account.
So at the end of the day, it all boils down to this one simple but powerful question. Are you seeking comfort or are you seeking cash flow? SCHD is comfort. It's cheap, it's reliable, it's predictable. QDVO is engineered for cash flow. It's tactical, it's active, and it's built to pay you monthly. The choice isn't about which one is better, but about which one is better for you right now.